Hi, everybody. I'm Herb Greenberg, and this should be quite an interesting chat today. I'm talking with George Baxter, who runs Sabrepoint Capital Management. That's a hedge fund in Dallas that is long and short stocks. Now, chances are you've never heard of George. He's not out there everywhere in the media. I know I hadn't until a friend introduced us a number of years ago, with the caveat that George tends not to want to go on the record on things. He tends to be background on a lot, or historically has been, especially with his shorts. And I should point out these, if I understand George correctly, these are not your regular shorts. He tends to gravitate to those really crummy, even sleazy, maybe even fraudulent companies. His longs are a different story. And with that shorting as a background, he tends to look for, like as you would expect, higher quality companies or interesting companies. And he does his research. That's one of the hallmarks of really great short sellers, especially when they're going long. And that's what we're going to talk about today is those longs, and not just any longs, but one stock that he says he considers to be his single best long, the single best long of his career. Now, he may correct me when we get to him, but that's what he says in his writing and to me, and which I wrote about. This company is called Turning Point Brands, and I wrote about it based on George's thesis, interviewing George back in July. George likes it because it makes nicotine pouches, which very maybe, possibly, he's using right now. Am I right, George? Welcome.
That's right. I've got my free wintergreen 6, so I'm at 20 points.
That's that's exciting. Well, so before we get into that, full disclosure, I bought some shares, small amount of these shares, a few weeks after I wrote about it. And before we even got there, one thing we said, I wrote about it in the report, was, this is such a fascinating story. Maybe we should just do a podcast or a video cast on it at some point. But of course, I don't have a podcast. I don't do videos for the most part. And I went on vacation. But I'm evolving to do different things. Old dogs do, well, I'm not even an old dog learning new tricks. This isn't a new trick to me, but I am an old dog. Anyway, before we get going here, George, who are you?
Well, I'm a bit of an odd duck in that I didn't come to become portfolio manager of a hedge fund in the most traditional manner. I did not have a business background initially, but when I was in law school, a friend of mine had come into a fair amount of money through he worked for Mark Cuban at broadcast.com. When they got acquired by Yahoo, he reached out to me. We actually talked all the time. And I was intrigued because he started pestering me about investing in stocks. I'd been investing in stocks since I was in middle school. I didn't know anything. I couldn't tell you what a PE ratio was. And but my friend is very intelligent and very thoughtful, and he started reading everything he could about how he could put that money to work. And we'd talk about it all the time. The next thing I knew, before I went to law school, I'd written several books about a strategy game called Magic the Gathering, and it helped me pay for law school. I didn't have any student loans, but I didn't have a lot of extra capital to start trading, so I took out student loans and started trading while I was in law school, and I got the bug. And I switched from focusing on litigation to corporate law, and ended up becoming a corporate M&A and securities lawyer, and ran money for my family for about 5 years practicing law. And I have an advantage. I don't pay any attention to sports. I don't really, so all my free time was spent studying investing. I read about every value investing book I could get my hands on, and went to every Berkshire Hathaway annual meeting for several years. And eventually I quit my job. I was working for Weil Gotshon Manges as a private equity slash securities lawyer. Did a lot of work on Enron. I actually turned the lights off on Enron stock. It's one of my claims to fame. And
What do you mean by that? What do you mean you turn the lights off on Enron stock?
so literally, we worked with the depository trust company and stopped the trading for Enron. And this is post bankruptcy. And it really kind of exemplified how inefficient markets are, because 2 days before we shut it off, it was up 36%. The day before we shut it off, it was up 8%. And you could see on the Yahoo message boards, people talking about all this value that was in Enron stock. And we sent notices that said there is no value in the equity. There absolutely none. And still people traded it because they were sure there was something there. And then we took it off the board the next day, and it was fully disclosed. It was out there. But unfortunately, there's a lot of people that have a narrative or a notion, and you see this all the time in the market, where they're literally Mr. Market, right? They're out there trading on a story, trading on a perception they have without really having any fundamental analysis to back it up. And that today is more extreme than it's ever been.
We say that constantly, that this feels different, that this is, boy, we've never seen this, but we have seen this. We have seen times like this, certainly throughout my career, and each time it feels bad. The difference today, and I've talked a lot about it, is you have elements to the market that we didn't have in prior cycles that just exaggerate it, fueled in the end by whether it's social media, the sports gaming aspect of it, which is, there's always been an element of momentum, and that's always been part of the market with technicians and people who practice that art and do it well, and others who think they can, day traders, that type of situation. But this time, people will throw it out there. The pod shops, the algos, you name it, it's there. But Renaissance, I talk about algos, Renaissance has been out there for a very long period of time. They sort of got that whole part of it going. So there's a lot going on in these markets, but your interest in short selling, which I want to get to at the end of this, but I am curious, before we get to that, just as a tease, through all of this, it must have painted that picture to you that you saw this other side of the street. You saw the opportunity of the value, but also these other things.
Yeah, initially I was purely focused on the long side because that's how you start. And I didn't really, there was an evolution for me with respect to the short side of the book. And there's a great study that was done in the University of Arizona. I want to say it was a year or two ago. And what a lot of people don't understand is that the vast majority of stocks underperform the market. It's really that top decile that dominates market performance. And there are, somewhere along the lines of 40 to 45% of stocks actually end up losing money from their original offering price. So, and there's stocks that fall apart all the time. It's really easier to throw a dart and hit a short than it is to throw a dart and hit a really high quality long.
I've come to conclude, after all the years of doing this and watching ideas I talk about get squeezed to high heaven and things like that, that a great deal of my subscribers or fund managers are what I call hybrids. They use technical analysis as part of what they do, but it's under it's sort of like, intertwined with fundamentals. I used to talk about this back when I used to work with Jim Cramer at the Street. One thing I learned about Jim, and a lot of people have all these comments about Jim, but what I'll say about Jim is Jim had a team of analysts around him. He traded the technicals, but he knew he could game it because his brain fires in a lot of different ways. He could game, or what he thought he could game, the technicals against the fundamentals. And that goes way back. We're talking back in the 90s and in that period of time. But I think today, even when we talk about this, your portfolio last week, I wrote a thing about a week ago where I quoted Steve Straza, who works at All Star Charts, which is part of the platform that I'm engaged with, a broader platform called Stock Market Media. And he had written, he's a technical analyst, and he had written, now the bad ones are going up, something like that. Or I was on a call and he was talking about now the worst of them are getting pulled up. And he said, that's, for somebody who's looking at quote unquote making money on the long side and trading that, was music to his ears. Now, it'll be interesting to see what happens on the other side. But, these people watch it pretty closely. But it was interesting to watch him say that, and then watch what happens subsequent to that in this environment. But look, we go on and talk. Let's get to the topic du jour, and is Turning Point Brands.
Yes.
Now, I find it interesting as a short seller, and this is what intrigues me. Here you are. You're not a guy who's constantly out there in the media, at least not yet. Every now and then you do stuff, and you once had a podcast on behavioral, which, by the way, is very important here, which we need to get to at some point. Your focus on behavioral activities as it relates to investing. But I think when I see short sellers who are long, I often say, well, some of the worst longs are short sellers. But having done some long research myself a few years ago, when I really just decided I was going to just do nothing but long research, the first thing that came into my head was, I am afraid of being wrong. Because if I'm wrong and my friends come in and make a fool out of me, that's going to be embarrassing. So it's constantly, the first question I kept asking was, how can I be wrong? How can I be wrong? What's going to cause this to be a problem? So here you are, not just any old short seller, but the crummy companies are the ones you want. You're long a company many people have never heard of called Turning Point Brands. It's in an area that is, from zigzag paper to, snuff or smokeless tobacco to now nicotine patches. And you've done enormous amounts of work on it. So when you said, not only will you talk about it, here you are, again, I'm thinking, okay, this guy is biased negative in the way he thinks on a lot of things. You're going to look at the risk. You also call it you think it's the best long of your career. Tell me why.
So in every investment decision that we make, there are gray areas where you don't know, right? You're making an odds-on bet. You're looking at different things. And you're saying, okay, well, I can see this as a positive and this as a positive, but there's a veil that separates you from, and it's true for everything. I mean, even if you're working within a company, you suffer from this veil of uncertainty. And when I look at the business of cigarettes initially, it is the best business ever in terms of the business. Cigarettes are the most destructive product ever. They kill more people than auto accidents. I mean, if you look at the CDC, I want to say it's like there's 380,000 smoking related deaths annually. That is a huge number of people. And you can stack up drug overdose, whatever, horrible societal business. But the business itself, you make it for nothing. Buffett once had a quote. He said, cigarettes are products that you can make for a penny, sell them for $1 at the time. At the time he made the quote, that was what it was. You can make it for a penny, sell it for $1. People are brand loyal, and it's addictive. Okay. Nicotine pouches are like the antithesis of cigarettes from a health perspective, because they can help people have a roadmap to get off of smoking. And unlike cigarettes, which essentially among a lot of people, you're a pariah if you smoke or you vape, and there's a lot of places where you can't use it. Nicotine pouches are extremely discreet, right? So I've got one that I'm using right now. I pretty much wake up in the morning and put one in. I have one in pretty much until I go to bed, right? So the opportunities for using it are much broader. This market is probably, maybe energy drinks grew like this when they were initially, when you had Monster and Red Bull, but I've not really seen other consumer products like this in my career. And I knew Turning Point because we were involved with Turning Point pretty much close to when we launched the fund back in 2016. Now, at that point in time, they were zigzag rolling papers, Stoker's moist snuff, and then they had a vapor business. And we all know what happened with vapor, right? It was a disaster. And we've been in the stock, was a huge winner for us for several years. But then you had VapeGate, right, where vapor ended up. There were some kids that actually got killed using vapor. They were using it with marijuana pods, but there was a huge backlash, and 40% of high school students were using vapor at the time, and so there was massive regulation that essentially destroyed that business for Turning Point. So we'd exited the stock probably not early enough as all that developed, because the remaining business was excellent. Then they launched Free, which I was skeptical of initially.
So Free, let's make a point. So what is Free?
Free is a nicotine pouch.
Okay.
And
so it has two brands.
Pouches,
they have two brands of nicotine pouches. Okay, so they
launched
Free. Okay.
They have Free, and then they have a JV that they've done with Tucker Carlson for Alp. And Alp is amazing. They're essentially the same product. Like if you try the products, they're not really distinguishable from one another, except for maybe some flavors and then the branding. But the branding for Alp it's one of the most powerful brands I've ever seen. And I'm not saying that lightly. There are reviews that users can leave for this product as they check out the Shopify app that Alp uses online. Last I looked, there were 35,000 of these reviews, most of them videos, and there are people raving about how much they love the product. One of which I came across, there was a guy who had a tattoo of the Alp logo.
Oh,
I've only seen
by the way, when you've seen that before?
Harley Davidson.
No, I would actually add one more, Monster Beverage.
Really? I had not. Oh yeah, that's right, Monster Beverage. But those are extremely powerful brands. Whenever you have a brand where it's not just the product, the brand conveys that there's some consistency with what it is. You trust it. It's a product that you've used. You have expectations that are built into it. These are brands where your identity of who you are is attached to the brand. And when that happens, those people become walking commercials.
Okay, what is the difference though? You say they're almost identical products, but one is a JV, the other is not.
Wholly owned.
And we're talking about something I should mention. These products from this company are 2 years old.
Yeah, so they launched in January of 24.
Okay, so what makes Free different from Alp?
So Free is 100% controlled by Turning Point Brands. They have separate sales teams, separate marketing, okay? But Alp is manufactured and distributed by Turning Point. And they have
Free.
Alp. Yeah.
Okay,
Alp.
But Free is sold retail and Alp is not. Is that really one of the main differences?
Well, not yet. And I say not yet. Free, we estimate based off of a store scrape of Turning Point's store locator for Free, that Free is currently in 35,000 stores, a little bit more than that.
Mostly convenience?
Mostly convenience, but the largest chain that holds them is Walgreens. There's over 1,000 Walgreens locations that they're in. But Alp is in 900 stores, okay? And the way people get Alp, the way they have it in their store, typically, they have some chain deals that they've recently done, but they're small. Literally, the retailer reaches out via their web portal, and orders it directly from Alp at not a huge discount. We believe it's 10%, right? That's the offer that they have, which is that's a crazy. Typically you're going to give retailers going to have maybe a 25 to 30% margin based off of the price. But here they're giving them a 10% discount to what they're selling Alp on. Now, there may be other arrangements that we don't see where that discount may be bigger, but that's what we've seen up to this point. But the point is that literally this is a demand pull, right? Where people are reaching out to the company to put it in, as opposed to a salesperson that comes in, pitches the product to the retailer, and then ultimately they get into the distributors like McLean or Core-Mark.
Well, but there's an elephant in the room here, and the elephant in the room is known as Zinn and Phillip Morris. So we're talking about two products here that you're talking about at a fairly small company. What's the market cap of this company right now?
I think it's 1.8 billion.
Okay, so we're talking about two products that have a minuscule share of a market dominated and has been the story behind the remarkable growth of Phillip Morris's stock. And you're sitting here telling me this little pissant company can take on not just Phillip Morris, but a few other biggies out there. And it's going to, so why? What, man, I'm perplexed here.
Because I've seen it before, Herb. There's this little product called Stoker's, okay? And that's their moist snuff product. When we first started meeting with them, I was intrigued with Larry Wexler, who was the CEO at the time of Turning Point Brands. And this guy used to work, these are all former Phillip Morris guys that were in the management. And Larry there's actually like a Harvard Business Review about Larry or case study. He was the author of the Friday Night Massacre, which is when Phillip Morris dropped its prices by 20% overnight because there were all these value brands that were taking share to crush them. And he devised that strategy. And he's a street fighter. Now he's now on the board, and his protege, Graham Purdy, who's one of the most creative CEOs I've met, his background is more sales oriented. Graham Purdy is now the current CEO. But I watched these guys go from a 2 share with a business that was selling moist snuff in tubs, right? They didn't even have cans. And it was a big discount to the big guys. And now they're like a 7.5 share. And I believe within the stores that they're in, it's more like a 14 share. So despite the fact that their competitors, they're fighting with Skull, Grizzly, Longhorn, they've grown units and they've grown on price because they just, when their competitors would raise price, they would just step up a bit to follow them. So one thing that's interesting about tobacco companies, they have such a fantastic business that there's not a lot of innovation that you see that comes out of them. Literally they'll just go and raise price. I mean, that's always the answer. Volumes are down because fewer people smoke, raise price. The innovation tends to come from smaller companies, and that's what Turning Point has had. And they've managed to compete successfully because of the barrier to entry. They have a sales force, regional sales forces that literally go out to independent stores, because there's a number of stores where they're owned by entrepreneurs. They're not necessarily, they could be a franchisee, but they'll literally go and send a salesperson into the store with their product in the car. They'll sell it to that person, get them hooked into their system. And once there's enough concentration within a particular region, then they go to a Core-Mark and they get on the catalog.
So how's the share in this short amount of time? What have you seen with the share of these two products? And knowing that, by the way, one thing you didn't say, but you told me, and I had the report, is I think most of Alp is still online sales, and which differentiates it in that regard. But it's becoming anyway. So before we get to this next question, what's the share gain so far? Where is this? I mean, is it 2% in the market, 3%?
So at this point in time, the market is somewhere in the neighborhood of 4.5 billion, and sales for Turning Point right now, they did 30 million in nicotine pouch in the last quarter. Now, it is growing tremendously on a sequential basis, not an annual basis, a sequential basis. Last quarter, they grew 35% sequentially. In the previous quarter, they grew 100% sequentially, right? So, and we think that this next quarter they'll probably grow in excess of 20.
But this is new doors, not new customers.
No. New doors, higher prices, and higher same store sales.
Well, what percentage of the gains are volume versus price? You know, are they
Volume versus price. Prices probably somewhere in the neighborhood. It's difficult to see because we can see the increase in price at retail, and there's a slide that that we can share here on pricing, and you can see that they've gone from essentially maybe $2.75 per can for free up to just below $4 a can.
What's the elasticity of the pricing? How much do you peak out, and what's the competition in pricing? And can't the big guy end up just coming in and trying to undercut them on pricing?
They have been. Okay, there's so the big advantage that I'll just the punchline here is we had a position at Turning Point because I saw that there was growth and I could look at the metrics and I understood, okay, this is good, right? And I had quit when we first got involved with them. I had to try the products. I got addicted to vaping. I quit. But I was like, I've got to try these pouches. So I tried every pouch. And when I did, it was clear to me Turning Point has the best product because they have a moist pouch as opposed to a dry pouch. Their product is better than others. Okay, period. It is just a better experience. Now, there's also some studies that show
said the man who owns a bunch of the stock.
That's true. I mean, that is actually, and I was going to say that, by the way. And so I'm definitely biased. Psychologically, I'm biased to feel that way. But I have other evidence that suggests that that's the case. Among people that try Free, and this is done by the Hedge Group, which is the largest online retailer of nicotine pouches. That's a good story too, and we own the stock. It's
what's the symbol?
Well, it's HAYPP. It's on the Swedish exchange.
Oh, I see.
Yeah. So it's less liquid too. It's not as big.
Yeah, I see.
But anyway, they do a lot of metrics where they analyze the purchasers of various products, and they provide that for a fee to the tobacco companies. And among people that have tried Free, the first statistic I saw was for the fourth quarter of last year, 27% of them chose it as their brand. And then recently they just had the next one. Now it's 30%. So like there is, and this is, as you mentioned, this is a little bitty company, right? 1.7 billion. Phillip Morris International is a $250 billion company.
What percentage of Phillip Morris is pouches versus this company?
Yeah. So as of the last quarter, nicotine pouches were 26% of Turning Point's revenue.
How much?
26%.
Okay.
Phillip Morris, what's driven Phillip Morris to double over the last, year, their nicotine pouches are about 6% of their revenue.
Okay, you one of your strategies is asymmetric. You look for asymmetric gains, things that have asymmetric potential versus the market. Does this fit in that category?
Does it? I mean, I'll put it to you this way: when we bought it, for sure. I would say that yes, it does. Like you could justify this on a lower growth value basis if you reduce the SG&A for a lower growth profile. And I would think that it would be reasonably priced. But we've moved, when I first shared it with you, and you wrote about it, I believe it was at $70 a share. Well, we think that the base business is probably worth $50 to $55 a share. So you were not paying much for the nicotine pouch business, and you already had enough sales where if you could bring down the SG&A, that you could justify it at that price. But Since then, the stock has gone to about $100 a share. But we think that ultimately, I can see this getting to over $700 a share by the end of the decade.
By the end of the day, what about in 2 years?
2 years. I mean, I think next year it'll more than double.
So what would you
I mean,
say if you're wrong? If you're wrong,
that's with the caveat that the market doesn't collapse, right?
all right, yeah. So we assume the market's going to probably have some sort of a hiccup here somewhere, but if you look out, you have base case, you have best case, you have bull case, the best
Yes.
possible. Where would you see the worst situation where you'd be very disappointed in this company from a stock performance standpoint based on your analysis?
Well, I would say that it's difficult to measure because the risks, if they were to come to fruition, could be pretty
Talk about it.
right. But I think they're very unlikely. But
Go ahead.
like for instance, if for some reason Tucker Carlson gets sideways with Donald Trump, that could happen. Trump has been pretty vocal about doing things against people who are not his in his circle, and that could be a risk for sure.
Yeah, we've talked about risks, and we've talked about that Tucker Carlson is a risk. What I'm fascinated by is when we talk about this company, and I've talked to a lot of people who are bullish on companies and bearish on companies over time. There's a lot of conviction. Everybody has conviction. That's why they're long or short stock. But there's levels of conviction. But some people have extraordinary hubris where they never acknowledge that they may be wrong. And one thing you acknowledged here to me and in your writings is that you very well could be, you always say it, you say, hey, look, I could be wrong here. But here's the twist. And the twist is that your firm bought this at what price?
About $40 a share.
You bought it individually where you now own stock. What price?
73.
And
I'm buying it again, by the way.
You're buying it again up here. You're averaging up.
Yes.
That's interesting. So but you also told me that you have because obviously watching you talk about a company like this and you now own it personally, your firm owns it. So there gets to be, well, George.
And I have a deal. I cannot sell a share unless my firm has zero.
Okay. One thing, and so your firm, which is you, but you'd have to sell it first, and then your personal account would take an
Yeah,
would take a hit.
my personal account is, my partners are not there. And
one thing I want to get back to on this market share thing, because I think it's important, is if Phillip Morris has 5 or 6%, or it's 5 or 6% of their market of their revenue, and it's 25%. How do you use that as part of your analysis to where you think this can go? Why is that discrepancy so important?
Well, so right now between the market size is about 4.5 billion today. On if you just took Turning Point's revenues and you flatlined them, that's $120 million. So that's like a little bit that's a little bit more than 2% share. Their goal is get to 10% share. If you look at the growth, and by the way, in the stores where Free is selling, they already have a 9 share. And that is increasing over time in terms of their same store sales share. So if within those stores, they have to just get the penetration. They have to get into the stores, which they're adding rapidly. If they can get to a 10 share and the market, which has been growing at a CAGR for the last 5 years of over 50%, if the market growth, if that growth slows, and there's a lot of projections out there, anywhere from 20 to 35% growth from now until the end of the decade, and they reach that 10 share, that means that the revenue for Turning Point at that point from nicotine pouch would be $1.5 billion, right? At a 30% CAGR from here.
Would dominate their business. What's the likelihood that they get acquired?
It's a good question. It would be very easy for one of the nicotine pouch because they are so small to buy them, but I don't think they're going to sell. I mean, everything I've talked to them about, they said like, look, we've got the ball, we're running with it, we're going to go.
You mentioned to me that there's a volatility risk here and that quarter to
Absolutely.
quarter. So what could happen here that, someone comes in, they see this, they hear this, say, oh, it's the greatest thing since sliced bread. And then they start assailing me at some point in the future, take a
Yeah.
number, stand in line, because it didn't quite go the way they expected because they're newbies to the market or whatever the case may be. So what should anyone who buys a stock right here, right now, including you buying it at higher prices, expect? Or what is that near-term risk?
So the near term risk, right now, there's a transition. And this is one of the reasons, since you wrote your article, this is one of the incremental things that have happened that I'm very excited about. 100% of what they sell, they import from India right now. Okay. I don't know if you guys have been watching the news, but there's a little tariff that's been put on India, 50% tariffs. But there is they're building domestic production today. There's a filing that was made with uh, the Kentucky, I guess it's Economic Development, you know, uh, division, where they're getting $1 million worth of tax breaks for an $18 million investment in their Kentucky facility in Louisville. They're going to build, we think they're going to build 10 lines. There are 8 lines in India. And we think that they'll probably be done by the end of the first quarter with that. They have room to build 30 lines
Okay.
in their facility.
So how does that get
This is why
in the
I'm
way
excited.
between here and there? Yeah.
This is why I'm excited about this prospect. So we've talked to a lot of different, we've talked to co-packers, we've talked to independent manufacturers, we've talked to, analysts that have been following the space for a long time. And we think that they can produce their pouches for $60 or 60 cents a can. Without the tariff, they're paying about $1 a can to their co-packer and 18 cents a can for air freight. So essentially, they'll get 60 cents a can in incremental gross profit next year. We think that they'll probably produce somewhere in the neighborhood of 70 million cans. There are 18 million shares outstanding. That's over $2 worth of earnings that they should be able to, or of gross profit that they should be able to derive just from that. That's.
So between here and there, though, what's the risk? You'd mentioned something like Q3 could be a little wobbly.
Q3 could be wobbly because you went from having a 10% tariff that they probably didn't see much of in Q2, right? Because their days inventory is about 60. So it takes 60 days for the inventory to flow through. So maybe on the back half, they had a little bit of that 10%. So Q3, you'll have a 10% tariff and a little bit of a tail for the 25% tariff. But then there was the extra 25% tariff because of the Russian oil. So depending on how that ramp goes, of them ramping up that manufacturing capability they have, they may have a period where they'd be under more pressure. But one thing that I saw, you can see sequentially in the Nielsen data, last quarter, based on the track channels, this is not everywhere they're selling, Free was growing 25% quarter over quarter. That accelerated this quarter to 38%. Okay. 38% quarter over quarter. Right. So I believe that even if they had to eat all of the 50% tariff, that the volume that they would do would allow them to exceed earnings, the estimates of the sell side.
Which risk here keeps you up at night the most on this? You have great conviction, but what gets you up at 2 o'clock in the morning on this one?
I think Tucker Carlson, the risk that he gets sideways or, looking further out in the next election, than if you have a change of administration that is not as does not embrace nicotine pouches like this one has. I mean, RFK Jr. has been in a couple of interviews now where he literally came out and said, the problem is not nicotine, the problem is smoking. Nicotine pouches are the safest alternative.
Both of these things cut both ways. I'm sure there's some people, when I first looked at this and saw it, I said, do I really want to own the stock? And sure, there are people who say, because you've also mentioned that this is there's a very rural component to this, to this, especially for Alp. Before we get going, because we're running out of time, you're also, importantly, just as a thread through everything you do, is behavioral. So you pay attention to behavioral. It seems to be part of everything you do. In this one, where does that tie in?
Well, for one, there is my own bias, right? That's the first thing that you have to, and confirmation bias is always a danger. So if you have a position like this one where I have so much work that I've done, and there's so many different things, the more work you do, you have a tendency to discount negative information and embrace positive information. If you ever get into an argument with somebody on a political issue, right? And you have very salient points, and then they'll come up with some counter argument. Usually they'll leave the argument being more convicted than they were before, right? Because they've seen the problem and they discounted it, and therefore they feel even stronger. So that's definitely the case with me, right? I've definitely, I am definitely more likely than not to be subject to confirmatory bias. The other thing that was more of a case when I initially shared this with you was, and it's more of an issue of just the disposition of the shareholder ownership. Turning Point was originally held by value guys, right? And value guys, they don't want to pay up for growth. And so they have had to go through this transition from a base that was very focused on value to one that's more appreciative of growth. And that created a real opportunity to buy this without a lot of downside. But now, I will say we are at a point where if for some reason, their nicotine pouches falter, then the stock would come under significant pressure.
Well, you obviously have weighed the odds, and given the strategy games you used to play, maybe still play, you've written books on, you obviously think the odds are in your favor. Look, this has been a fantastic conversation. Before we go, I just want to point out if you're a premium subscriber to my red flag alerts, you'll be getting a copy of George's decks. There are two decks. There's one that's like 65 pages long, another that's the Cliff's Notes version. It's about 15, 16 pages long with a bunch of disclaimers at the top. So those will be available to you if you're not a premium subscriber. Of course, I'd love you to become one because I fly red flags, even though sometimes I feel like the Maytag repairman, which is dating me, but I sometimes just feel pretty marginalized by the world. But I continue to believe it's extraordinarily important to pay attention to red flags, no matter what environment we're in. George explained it earlier. And if you would like to read the piece, it's on, I think it's behind the paywall, but it's on herbgreenberg.com. And it goes without saying, none of this, and I do mean none of this, is investment advice. As I always like to say at the end of my reports, interpret at will, because
yes, I could be insane. So,
Well, and I don't know you very well. So for all I know, I'll be getting some calls from people. Anyway, thanks a lot. Thanks, George. This has been a great conversation. Thanks, everybody, for joining us. And since I don't have a regular podcast or show or anything like that, I'd say see you next time, but we'll see you when I do. Take care, everybody.
Thank you, Herb.